The Bogleheads Guide to Investing is a comprehensive guide to personal finance, inspired by the principles of John C. Bogle, founder of the Vanguard Group and pioneer of index investing. Written by Taylor Larimore, Mel Lindauer, and Michael LeBoeuf, the book simplifies the often complex world of investing by focusing on long-term, low-cost, and disciplined strategies. Here's a summary of the core concepts from the book. 1. Investing basics. Focus on what you can control. The Bogleheads emphasize starting with a strong foundation. The first principle is to focus on what you can control: costs, asset allocation, and discipline. These factors significantly affect your long-term returns, unlike trying to time the market or predict individual stock performance, which are largely unpredictable. Costs. High fees and expenses can erode your returns. They advocate for low-cost index funds that mirror the performance of the overall market rather than high-fee actively managed funds. Time horizon. The longer you stay invested, the better your chances of success. Compounding works best over decades, so time in the market is more important than trying to time the market. Discipline. It's essential to stick with your plan, especially in volatile times. Emotional decisions often lead to selling low and buying high, which destroys wealth. 2. Live below your means and save early. A key to successful investing is living below your means and saving aggressively. The authors highlight the importance of establishing an emergency fund to cover unforeseen expenses, which will prevent you from dipping into your investments. They recommend automating savings as a way to consistently invest without needing to actively manage it. Starting early also allows the power of compound interest to work in your favor. Even small contributions early in life can grow significantly over decades. 3. Index funds, the core of Boglehead investing. The book strongly advocates for index funds, which are mutual funds that track a broad market index, such as the S&P 500. Bogleheads believe these funds offer several advantages. Diversification. By holding an index fund, you own a small portion of a wide variety of companies, reducing the risk of any one company or sector dramatically impacting your portfolio. Low costs. Index funds typically have much lower expense ratios compared to actively managed funds, where managers try and often fail to outperform the market. Simplicity. Index funds require less attention and effort since they automatically track the market. 4. Asset allocation, balancing risk and reward. Asset allocation. The way you divide your investments between different asset classes, such as stocks, bonds, and cash, is critical. The authors suggest a portfolio tailored to your risk tolerance and stage of life. Stocks. Over the long term, stocks offer the highest returns, but they are also more volatile. Younger investors, with a long time horizon, should have a higher allocation to stocks. Bonds. Bonds offer stability and are less volatile than stocks, providing balance in a portfolio. As you approach retirement, increasing your allocation to bonds can help protect your portfolio from market downturns. Rebalancing. Over time, the value of your stock and bond holdings will change. Regularly rebalancing your portfolio back to your target allocation ensures you maintain your desired risk level. 5. The power of compounding. The Bogleheads highlight the magic of compounding, where investment gains generate additional gains over time. This is why starting early is so crucial. They show that the earlier you start investing, the more time your money has to grow exponentially. For example, investing $10,000 at a 7% return will double in about 10 years and quadruple in 20 years. Even modest investments can grow significantly when given enough time. 6. Avoid market timing and stock picking. The book warns against trying to beat the market through stock picking or market timing. Bogleheads believe that the market is efficient, meaning all known information is already reflected in stock prices. Trying to guess when the market will rise or fall, or which stock will outperform, is nearly impossible for most investors. Instead, they recommend staying the course with a diversified, low-cost portfolio. Historically, broad market index funds have outperformed the majority of actively managed funds over the long term. 7. Tax-efficient investing. Tax efficiency is an important aspect of investing. The authors recommend strategies to minimize taxes such as tax-advantaged accounts. Make use of retirement accounts like IRAs and 401(k) KIAs where investments can grow tax-deferred or tax-free, depending on the account type. Tax-efficient fund placement. Place tax-inefficient investments, such as bonds, in tax-advantaged accounts, and keep tax-efficient ones, like stock index funds, in taxable accounts. Tax loss harvesting. This is the strategy of selling investments at a loss to offset gains, reducing your overall tax liability. 8. Stay the course. Avoid emotional reactions. A critical aspect of investing success is staying disciplined during market fluctuations. The authors stress that market volatility is normal, and short-term drops should not cause panic. History shows that the stock market has always recovered from downturns over the long term. They argue that having a solid long-term plan and sticking to it is the best way to build wealth. Emotional investing, buying high when the market is doing well and selling low during downturns, leads to underperformance. 9. Avoid common investing mistakes. The Bogleheads outline common mistakes that investors make. Chasing performance. Avoid hopping between funds that have recently performed well. Past performance is not indicative of future results. Overconfidence. Many investors believe they can outperform the market through stock picking or market timing, but most fail in the long term. Neglecting risk. Investors sometimes focus too much on returns and not enough on risk. Proper asset allocation helps manage risk and avoids overexposure to market downturns. 10. Create an investment policy statement, IPS. An investment policy statement, IPS, is a personalized roadmap that outlines your investment goals, risk tolerance, and asset allocation strategy. The Bogleheads encourage writing this down to guide your decisions, especially during volatile times. It helps prevent impulsive actions and ensures you stick to your long-term plan. Conclusion. The Bogleheads Guide to Investing promotes a disciplined, long-term approach to building wealth through low-cost, diversified index funds, proper asset allocation, and a focus on the factors within your control. By avoiding common investing mistakes and staying the course, investors can achieve financial security without falling prey to market noise or emotional decision-making.